How confident are you that the journal entries you create today won't unintentionally create tomorrow's headaches? All it takes, unfortunately, is one wrong move. Journal entries in accounting and accounts payable might not sound glamorous at first, but they hold the key to unlocking a world of organized finances and smarter decision making. In less than 10 minutes, we're going to break down how to use journal entries effectively, highlighting common type, and show you the hidden potential for mastering them. Trust me, by the end of this, you'll see why missing out on this talk could leave you with a serious deficit in your operation. Managing the accounts payable function may seem pretty straightforward when it comes to the accounting aspect, but like every other function, even one small mistake in recording a journal entry can lead to significant issues, including inaccurate financial reports. If you face challenges in your accounts payable operations, you know how time-consuming and frustrating reconciliation can be. The solution lies in understanding accounts payable journal entries. So, before we dive into the accounts payable journal entry specifics, let's make sure your foundation is rock solid, because a good portion of the mistakes in accounts payable can trace back to not understanding a very basic concept. So, what is a journal entry? A journal entry is a financial transaction that you record in the general ledger. Your general ledger is an essential part of your accounting system. It tracks individual transactions, which include the purchase of goods, sales you've earned, expenses that have been accrued, equity, etc. And now, more specifically, let's take a look at journal entries in accounts payable. So, what is an accounts payable journal entry? An accounts payable journal entry is a transaction, a financial transaction, that's recorded in the accounts payable ledger to document purchases that are made on credit. It ensures businesses clearly understand what their outstanding liabilities to suppliers and vendors are. It helps them zone in on payments that are less than or due in less than 12 months, or as the finance people like to say, the organization's short-term liabilities. This understanding is crucial for maintaining the organization's financial health and ensuring timely payments to all suppliers, but especially your critical suppliers. What are the different types of journal entries? There are several, and we're going to go over some of the more common ones. Okay, so let's start off with simple journal entries. Typically, these are one debit and one credit. Because remember, if you want everything to balance at the end of the month or the end of the quarter or the end, whatever the end of the period is, your debits and credits must equal. This is true regardless of any type of journal entry, and we're going to look at a few more intricate ones now. Compound journal entries are used when a single transaction affects more than one account, so two or more accounts. This is helpful in situations involving multifaceted transactions that cannot accurately be captured through a single debit and a single credit. Compound entries allow businesses to record these somewhat intricate transactions efficiently with one journal entry, keeping your records clean and easy to follow. For a simple example, consider the instance where a company pays employees' salaries, something that we all do. This involves paying out various deductions like tax withholding, insurance, and various benefits along with the net salary. Instead of creating multiple single entries, a single compound journal entry can be created to cover this one transaction, balancing out all your debits and credits. Adjusting journal entries. Adjusting journal entries is another type of record made at the end of an accounting period to ensure that the revenue and expenses are properly allocated to the correct period, even if they don't coincide with its cash flow. This is a crucial step in accrual accounting, and I'm guessing if you're watching this, almost all of you will be using accrual accounting. You won't be on a cash basis. These adjusting journal entries can be used to address issues like unprocessed invoices, which we all always have. These can be used to address issues like unprocessed invoices to make your books balance. Next type is closing journal entries, which are made at the end of an accounting period to prepare your books for the next period. They transfer balances from temporary accounts like revenue, expenses, dividends, etc., to permanent accounts like such as retained earnings. This process ensures that temporary accounts have a zero balance at the start of a new period, making them ready to start accumulating new transactions for the new period. Reversing journal entries. These are optional entries made at the beginning of an accounting period to undo a specific adjusting entry made at the end of the previous period. It's essentially the opposite of an adjusting entry and is often used to reverse the accrual of expenses or revenues. This helps simplify record keeping and ensures accurate financial statements by preventing double counting of expenses or revenues. They are typically recorded on the first day of a new accounting period before any of the other transactions go through. Okay, so now let's take a look at some of the types of accounts payable journal entries. Managing the accounts payable functions requires accurate journal entries to address the various scenarios that we run into in accounts payable. It makes it essential that you understand how to handle each of them. These entries will ensure a smooth financial operation by recording liabilities, processing payments, and adjusting discrepancies. So let's take a look at a few of them. Okay, the first one, probably the one that we're all familiar with, purchasing items on credit. Like when you get your payment terms net 30. The liability is recorded in the accounts payable ledger when the goods or services are purchased on credit. This entry helps track the organization's obligations to its vendors to ensure clear visibility of outstanding payment and helps you manage cash flow. Okay, the next transaction type, paying an invoice. When the invoice is paid, the transaction is recorded to reduce liabilities. Timely updates promote trust with vendors and ensure compliance with agreed upon terms. Timely updates also, by the way, go a long way to reducing your risk of making a duplicate payment. It won't guarantee it, but it'll help at least reduce the risk. Late payments, next type, the third type. Any late charges or penalties must also be recorded if the payment is made after the due date. This practice helps businesses analyze trends and strategize for better cash flow management. By focusing on late payments, the organization can zone in on whatever the weak links are in its process that prevented the invoice from being paid in a timely manner, and of course, hopefully fixed. The fourth type, voiding an invoice. So when an invoice is voided, and this does happen occasionally, the initial accounts payable entry is reversed to reflect the removal of that potential liability. This ensures financial accuracy and avoids discrepancy. This is critical if a second copy of an invoice somehow made it through and thus overstated the organization's obligations to a particular supplier. Adjusting an invoice. Adjustments for disputes, discounts, late fees, etc. must be promptly recorded. And we all have them. These entries ensure consistency and provide a true representation of the company's financial obligations. It should be noted that many organizations have a policy of never paying late fees, and hence they don't record them even if the supplier has included them on the invoice. Now, let's take a look at when you record journal entries in accounts payable. To ensure smooth accounts payable operation, it's important to not only understand what journal entries are and what to use them, but also when to record them. When is the right time? This involves knowing how and when to record transactions for purchases, payments, late fees, adjustments, etc. So let's go through a few familiar scenarios and talk about how they can be handled properly. So number one, if you're purchasing an item on credit, record the transaction upon receiving the invoice to accurately reflect the purchase. This means getting invoices entered as quickly as possible as you can and not having them lie around. A side benefit of doing this, getting it entered immediately, is you're less likely to get a second copy of the invoice entered. And if somebody calls up looking to see if you have the invoice, you'll at least be able to track. Now, the second type, if you're paying an invoice, when you're paying the invoice, record the transaction when the payment is made to keep your financial records updated. This goes a long way to avoiding duplicate payments if another copy of the invoice shows up, which, as most of you listening are painfully aware, they do quite frequently today. I know sometimes in organizations when payments are made outside the accounts payable space, maybe either in treasury or somewhere else in accounting, the staff who handles it will wait till the end of the day, the end of the week, or even worse, the end of the month to update the general ledger with this information. And unfortunately, that really allows those second invoices to slip through. With late payments, which regrettably happens to all of us, you want to record the transaction when the payment is made, and of course, don't forget you're going to include any penalties or additional costs, assuming, of course, that you pay them. You're not going to record them that the supplier charged a late fee if you don't pay. Despite your best efforts with journal entries, mistakes on journal entries sneak through all the time. To ensure that this doesn't happen on your watch, click on the link that has appeared on your YouTube screen and is in the description to learn some surprising ways mistakes creep into journal entries and what you can do to ensure it doesn't happen to you or while you're running the show. Good luck.